Alright everyone, so let me get a sense of the traders here in the room. Some of you are current DayTradeToWin clients, others may be new. So if you could just tell me how many new traders are here in the room, maybe beginner traders, or maybe those of you who don't know the methods that I teach. You're new to DayTradeToWin, so I get a good perspective of who's in the room here today. All right, very good. All right, so a little mix here of traders. Some with some experience, some new. Okay, very good. All right, so what I like to do here at DayTradeToWin is I want to show you guys something other than the norm. Okay, the norm being moving averages, or the norm being MACD and bands and things like that. I actually try to go a different route completely. I want to know what the price is doing, the candles are doing, and I want to trade off of price proving to me where it wants to go and what it wants to do. So the philosophy that I take when I look at trading is not normal compared to what you may have seen in the past. Okay. I do have a few courses. They're all based off of price action. I only have one software, which is the Atlas line, which is also price action, but it's a proprietary indicator called the Atlas line. But besides that, there's no candlestick interpretation. There's no Fibonacci's. There's no Gann. There's nothing like that that I show and I teach. I really want to know what's happening, whether it be the at the open method, or the trade scalper method, or the price action scalping, or blueprint, or roadmap, any of the methods that I teach. It's really all based off of price. Now, some of the methods are definitely gauged towards the E-mini and the S&P, but for the most part, the methods that I teach, since they are price action, they can be traded on anything, which is the great thing. And on top of that, when I look at trading the markets, I don't want to have a bias. Okay, I don't want to have a bias long or short. I'm always going to allow for price and the candles and how they set up to prove to me everything moving forward. So that's very important. One of the things that I talk about is using the ATR, the average true range. Hopefully you had an opportunity to see the videos that I have talking about it. And if anyone has any questions on that, I'll be happy to go over it as well today. Other things that I teach and I show you are how to recognize a situation where I call the yo-yo bars and yo-yo effect. And I'm sure there are other names for it. But when I consider a yo-yo or a yo-yo effect or yo-yo bars, I look at this where I see price coming down, and for some reason, and it can be any reason, support, resistance, whatever the case may be, news, something comes in and tells me that buyers are stepping in and buying. All right. Now, the only way to know that and to see that is if price completely reverses off of this move, almost like a yo-yo, a kid's toy, where the yo-yo goes down and then for some reason it comes right back up, we pull it back up, and in this case it would be buying pressure, and what you're left with is a big wick. And so you have this here, right? You have this here, right? You have it here. So it's really not a mystery, right? I don't want to say to you guys that this is a mystery. It's not a mystery. But when you look at trading price and price action, you have to take into consideration everything that's happening. So the first thing that I like to do is I like to understand where price is coming from and show me where price is going. Okay, and this is any market. I'm not only referring to, I have the E-mini S&P up, but it can be any market. So where is price coming from and where is it going? And if it's trying to go down in a trend, right? We see the trend here going down and down and down. If it's trying to go down and it comes to a point and you see these yo-yo bars happening, I want everyone to think of the green light in your mind and say, wait a minute, it's trying to go lower, but it's having a very difficult time. We could potentially see a reversal here. So whenever you see these yo-yo bars or yo-yo candles or whatever you want to call them appear, start thinking not that I'm ready to go long, and I'm not saying that, right? Because we have to put rules to everything and setups and stops and profits. But what I am saying is that at least let it be a leading indicator or forward thinking to tell you that something's internally changing within this downtrend. Okay? So when you look at price and how price reacts, you should take in all of these things into consideration when you look at the market, any market. Okay? So this would be a yo-yo bar to the downside. A yo-yo bar to the upside would be something that looks like the market goes, let me see if I can find it here. The market goes up and up and up, right? It's going up and up and up. And then something's telling you, you see this candle here with a yo-yo effect where it tries to go higher, right? And for whatever reason, sellers come in and sell hard. And it cannot continue higher and it gets pushed right back down. And what you're left with is a wick. So what you see here is a clear indication that internally something is changing in the market. And you could look at divergence, you could look at any of the methods that are out there that show you something's about to change. So definitely pay attention to these yo-yo bars. It typically indicates that the market is changing, that something's about to turn around, and maybe not right away. And that's where we put rules to everything, but at some point things are going to change. All right? So look for these yo-yo bars. Now, I also say that one yo-yo bar or one yo-yo candle is meaningless because we see them everywhere, right? You see them, you see one here, you see one here, you see one here, right? You see one here, here. So the idea of looking at one yo-yo bar to tell you something may not be enough evidence. And I love to use proof and evidence with price when I trade. So using just one of these yo-yo bars or yo-yo candles in reality is irrelevant because they're everywhere, right? There, there, there. But taking that into effect, I'm not just looking at one yo-yo bar or one yo-yo candle. I'd like to reference a grouping of them. Because when you have a grouping of yo-yo bars, yo-yo candles, it outweighs everything that happens. One candle by itself, yeah, it could be meaningful, definitely. But when you see a grouping of them, like this, pay attention. Something's about to happen. And that's when we start putting our methods and our rules together to tell us what to do next. Okay? It's very important. One of the questions that I received overnight, I sent a newsletter out. Those of you who are on the list are here in the room, and some of you may be new, but in the past I've spoken about terms that may be very new to traders, like what is first come, first serve, or what is front running. All these things that you may have not heard of, so I'm going to briefly go over them and answer your questions on them, in case you don't know. Front running, well, let me start off with, not front running, but let me start off with first come, first serve. First come, first serve is a way to understand how electronic markets work. In the past, when you're on the floor, you start yelling to get your order filled before everyone else. So you have conditions that you have to meet in order to get yourself in there. The louder you are, the brighter you are, the more attention you bring to yourself, maybe the better fill you get. But things are changing. If you ever look at the NASDAQ now, or the NYMEX or CME, you don't have the same amount of floor traders doing that. What you have is cubicles across the street or upstairs from the exchanges, or very close to the exchanges, where they can still trade and execute the trades and get the best fills possible because they're so close. I'm not sure if you guys know this, but there's only two or three banks in the United States that are allowed to have an exchange right inside the, or I should say, a computer system, I guess you could say, right inside the exchange to get the best fills. So if you think about how the trading world works, it's not fair to everyone. You only have two, I think it may be three now, but at the time it was just two banks that are allowed to have an actual server in the basement of the exchanges, whether it be the CME, the CBOT, and they get the best fills, right? And so if you think about all this automated trading that's going on and all this robotic stuff that's happening, you have a definite advantage if you're right there in the CME to execute trades, without a doubt. Okay. So looking at what first come first serve is all about, the first come first serve scenario occurs when you place an order, a limit order. You get in line, and it tries to be fair to everyone. You get in line and you say, I want to get filled at this value. Let's say it's 13. Let me just put this here. Let's say it's 13.95 quarter. Okay, let's just say it's 13.95 quarter. So you want this fill here, and when price reaches that fill, if it happens to hit it again, 13.95 quarter, the process of who's in line first or who placed that order first begins to take effect. And that's what first come first serve is all about. In stocks, it's a little bit different, because in stocks they try to fill the little guy first before the big lots come in. But in futures, you have the first come first serve rule, which if there are, let's say, I made an example of this in the newsletter, if there are 5,000 traders waiting for this price, 13.95 quarter, right here, and only 200 contracts trade at that value, only the first 200 people who had an order they were waiting to be filled were actually filled. Everyone else, the 4,800, got left out. So if it ever happens to you where you enter into a trade and or you have a limit order to go into a trade and it hits and it hits and it hits and it hits and you never get filled, what happens is this: there are only a very small amount of contracts that were filled at that price, and you were not one of them. So think about how that works. Now, when you think about entering maybe a tick in front of that value, you should think about that under certain conditions, especially when the market's slow or when the market is whipsaw or ranging or at these even numbers. Okay? So if you have an order waiting for, let's say, 1400 as the example I gave, and what happens is price hits that 1400 and you aren't filled, think about placing an order just one tick in front of it, and that's called front running. So in order to alleviate the problem where first come first serve doesn't help you, place an order in front of it just by a tick, and I call that front running the trade, where as it goes through it, you got filled, but the guy or the trader at 13.95 quarter did not. So these are things that you should understand about the market. Now obviously if it goes through it, everybody gets filled and there's no problem. Okay? It's slow, Finley, absolutely. Let's take a look at some questions here. Usually summer months, Finley, are typically slow. So Finley says here, John Paul ATR not moving a lot to trade ES this month. Hard for scalping or hard for trading. It's typical in summer months for the market to be slow. But I'm going to get back to that in a second because I do have some thoughts on that as well. Because I don't think, Finley, it's going to be like this for too much longer. Okay. Andre, it's the same in Forex, absolutely. Does a market order placed by someone after your limit order, will they go ahead of your order? No, Anthony. The way it works is the first person that trades, the first person that places a limit order in, let's say they want it at 97.50, and then everybody that comes after you, they get in the back of the line. So it's as if you go to the counter and you take a ticket when you go food shopping. If you get deli meat, if you're in the States, we have you take a ticket when you go to the supermarket or the meat market or whatever, and you take a ticket. Then the person behind you takes a ticket as well. Okay, so that's how it happens. Okay. The same thing for exits, Andre, and the same thing for entries. Absolutely. All right, let me show you. Some of you guys are asking about the Atlas line. Here, let me show you here. Let me add the Atlas line to the chart. 9:30. Some of you took this trade, right? Over here. What you're seeing here is the Atlas line. There's been a lot of flip-flop recently, back and forth. Last day or two. Here's the Atlas line trade for today. 13.93 was your entry. And remember, I look at the ATR to start off my profit target, right? So if the ATR is looking at 1.5, 1.25, that's really what I could expect. And I would refer you to some videos that I have on how to use the ATR tool as well. Okay? Yeah, it's right, Finley. When the market is slow, you have the market jump like this, really strong, and then it starts to go small, and then it jumps again, and it goes small. Yeah, it's common. Now, one of the things that Finley here is asking about is, what about the summer months? Okay, are the summer months typically slow like this, and when to expect, and when is it going to turn around? And I have to say that, as history would give us any indication, definitely July and August have been typically the slower months, or the months that we have a little bit more of erratic trading. September, it's kind of a back-to-school month. Everybody starts looking into the fourth quarter profits, and things typically pick up beginning of September. That being said, if you think about what happened in late August last year, we had a huge amount of volatility that occurred in 2011 in August. So you have a very slow June, July, and then all of a sudden, I think it was mid-August, or maybe for part of August, it was crazy. All right, it was very, very hectic. So what that means, and I'm not saying that that's going to happen again this August, which just began, but I am saying that if it happened last year, it could potentially happen this year as well, especially with the elections coming up. So, yes, Finley, I will. I'll do that for you. Definitely, I'll put it on the blog. Okay. So, think about what happened last August and compare it to where we are right now. It's been kind of slow. If you see it starting to pick up very strongly, it's an indication that we're going to have a volatile end of the year, just like we had last year. Okay. Any questions on that? Any questions on what front running is all about, or any questions on this first come, first serve scenario? Okay, very good. Now let's talk about something a little bit different. And does anyone have any questions on the what I'm referring to as these yo-yo bars or yo-yo effect, where price comes down multiple times, tries to go lower, but at each step of the way it's stopping. So it's not just by one candle that I'm showing you this. It's by multiple candles that it's a dead giveaway that something is about to happen. Okay, so look for the yo-yo bars, yo-yo effects. Okay. Okay. Now, when you look at scalping the market, or you look at taking any type of profit, it's very important to understand what are the current conditions, right? Are we slow? Are we fast? What's happening, right? I'm going to refer again to the average true range, the ATR. Tell me what's happening in the market so I know what to expect. Now, some of you here are signed up, Arlene, I think, are signed up for the next mentorship program, which starts on Wednesday or Thursday. I haven't decided yet. So Wednesday or Thursday, we start a new 8-week mentorship class, which is going to put us into October. So those of you who are asking about this, there's still time to sign up. I recommend that if you really want to look at trading using price action and learning, all the methods are included, Atlas lines included, roadmap, blueprint, all of my methods are included, and everything is recorded for you in your own private login. I definitely recommend taking this course, as it will completely change the way you think about trading the markets. Okay, so it starts on August 15th, August 16th next week, and we're going to go straight for 8 weeks on that. Now, if you think about what you see right now, I can tell you that this is giving you that same yo-yo effect, but it's not enough. I need a few more bars to actually tell me, all right, now we're changing or now we're reversing. So again, one candle by itself is not enough info to tell me anything at this moment. Okay. Another thing that I like to look at is specific values of where the market stops and turns around and possibly reverses. Now, what I mean by that is we all know that the market's manipulated, okay? And I can say to you in every single day, if you look at specific places where the market turns around, there's a reason why that market stopped and turned. Sometimes it's very noticeable, other times it's subtle, but there's always a reason why it happens. You and I, the little people here, the little fish, do not move this market. Who moves this market are the bigger fish. If they want to stop that market at 1398, they sell 2,000, 3,000, 4,000 lots, shares, contracts, whatever you say, whatever you want to call it, and the market will stop and reverse. So if you know where these values occur, and if you have an understanding of where the larger money does this, it would greatly interest you on how this actually works, or how this changes the whole concept of trading. Now, it's not overly complicated. It does take some time to explain, but as the market goes up and up and up, like this, okay? What would happen if a larger trader places a 500 or 1,000 lot trade here? Definitely the market would jump up and reverse. So when you see the market coming down and down and down, they're overriding everything. They're overriding everything that's coming to the short side and absorbing it all. Now there's a reason why they're absorbing it, okay? And they don't want it to go lower. And as the market continues to go higher, they're going to continue to buy and buy and buy and buy and buy and buy okay? Because they want better fills. They don't want to just override this market. At some point, they have accumulated enough contracts where they want to get out of the market. If you know where this occurs, it's very valuable, because as soon as they're accumulating, it's this accumulating distribution aspect of trading. You can also see in the Commitment of Traders report that come out 2 weeks in arrears, but that's for a more longer term situation. For a shorter term situation, when this occurs, they are accumulating on the way up, but when they get out of the trade, they don't do it the same way. They just blow it out and say, get me out. Maybe they do it in 3 or 4 sections, but they definitely aren't doing that on the way up. And when they unload all of their contracts here at one point, it will create a V like this. This is what I'm after. If you know where this occurs, this is of the utmost importance. Okay? News long, Finley. Okay, let's take a look at it. This morning we had a news event. Was it 8:30 news event? I have to bring up the Bloomberg. So 8:30 here was the news event. Is this what you're referring to? It has to be a chaotic bar if there was an 8:30 news event this morning. And this isn't a chaotic situation. So I have to look at, if you want to trade the news, Finley, the way that I do, I have to look at a candle that's chaotic. All right, and I'll show you an example of that as well. Okay, I'll show you an example of that as well. Some of you are asking about the Atlas line here. What, 7:30? Okay. Okay. Here is the Atlas line for the Russell for today. Right, to go long at 796.30. Here's the Atlas line for the Euro. Here. Had a short trade here that didn't amount to anything. Turned into a long. Here's the Atlas line for all you crazy oil traders out there. Short over here. $92.80. And any other markets that you want to look at. So that's the crude, that's the Euro, that's the Russell, that's the E-mini. Okay? So speaking about trading the news, let me go to a economic calendar so I can see what happened earlier this morning. And unfortunately, Finley, here's the news event here. I have to see a red candle or red bar. And so there's not a red candle or red bar here. I didn't think there was. I didn't see one early this morning. So you have to have something that tells me the market's going to go crazy. All right? Now, if you take a look at Thursday, August 9th, yesterday, I'll go back to yesterday, and let's take a look at what happened, and I'll show you exactly how I trade the news here at 8:30. Okay? So this I'm going to show you yesterday. So let me remove here everything off the chart. Nice clean chart. That's how I like to trade, and that's how I teach it. Let's take a look at yesterday at 8:30 Eastern Standard Time. And here we have the chaotic candle. Some of you may already know this watching the videos, but let me just review it for you guys. Here we have a chaotic move that occurred. So I know that there's a 8:30 news event, right? I take a look at my Bloomberg, and actually you can actually download this news indicator from DayTradeToWin.com. under free software, and it could tell you and upload on your chart automatically on your chart when there is a news event, and it tells you a day or two in advance, however you want to set it. You can set it for international, you can set it for US only. So it's a very cool free little indicator that if you don't have it, I recommend you download it, at least to let you know if you're going into a trade that's going to cause trouble. Alright? So you can download it free on the site. So yesterday we have 8:30 international and jobless. I know that I don't really want to be in the market at that time because it could be chaotic. And so the first rule that I look at is I look at taking a look at the news event, and more importantly, was there a chaotic event that occurred? So this is actually very, very important to tell me, was there something chaotic that happened? Whatever the news event occurred, I don't look at the reports, but they took a bearish stance. How do I know that? Well, I look at a red candle or a green candle as the initial reaction to the news. Okay? So I'm not really interested in getting mixed up with this whole chaos of trading the news. Or some traders like to bracket it off, do things like that. I don't do that. I sit on the sidelines and I say to myself, what was the initial reaction to this economic report? And if it was a red candle, as it was, I don't want to go short. Instead, I'm going to look for an opportunity to buy when it happens. And the same thing, if this happened to be a green bar, I'm not going long, I'm looking for an opportunity to go short. So, as we move forward in time, remember, I'm not thinking about going short. I'm thinking about possibly going long when and if the opportunity arises. Now, remember, price action and proof is everything to me. When you look at a candle like this, what is the reason for a candle like that to post? Why would a candle that large come out of the woodwork? Anybody have any idea? What do you guys think? Why would this candle be so much larger than anything before it? Well, I'll tell you. Not necessarily, Bob, big institution buys, right? You're looking at all of the traders that failed, that were short here. And remember, not everyone got short at the top of this move. Most traders got short here during the bottom of this move. What you're looking at is everyone who was short now coming to the realization that market's not that in bad of a shape, or maybe something else came in and said, you know, things aren't that bad, or whatever. It doesn't really matter, and I don't care. What I do care is that this candle plotted showing me that all of these traders that were short are now reversing and giving up holding onto this short trade. And so if you look at this large green bar that posted, it was a reaction to everyone getting stopped out. They have to buy the market in order to get out of their short positions. Not only that, many traders hit the reverse key. Again, price action will always tell you what's happening. And if you see a large candle like that, it could be many reasons, but in this specific example, I guarantee you it's when the market hits all of these stops and reversals, it will automatically just flip to the opposite side and give you a huge bar. Now, how do we take advantage of that? I said that I didn't want to go short, I want to go long. The opportunity occurs when you have one, even possibly two, and many traders tell me they like it just when just one candle closes above. But I always like to have a little bit extra confidence that we're going in that direction. So I look for, as a trigger, 2 consecutive closings. Consecutive closings above the high of the red chaotic candle at any time throughout the day. At any time throughout the day. Short covering, right, Rob? Exactly. Now, I think somebody had a question here, which was, why do you consider this candle chaotic? I forgot who asked me. That Alejandro. I'll tell you. Sometimes news events do not create a chaotic candle. Sometimes it's trading as normal, right? Trading as usual. But especially when a news event comes out, I'm expecting the market to do something, go up, go down, and my reference is going to be, is it larger than the last few bars that came prior to it? So it's a little bit larger than this one, but anything that you see here prior to it, this candle, the range, the high and the low, is much larger. So, I mean, it's comparable to this one, but not the immediately last 3 or 4 bars. So I look at a reaction. Was it a reactive candle based solely on news? Okay, Alejandro? And that's why I consider that, and I can take that. If this candle was and looked exactly the same as this, then I would say there's no reaction, so I can't trade it. I have to only trade this news event when there's some type of reaction happening to it. Okay? No, Alejandro. It was it's not a what's the question here? I'm sorry. No, it's not the body, the range. So it has to be the entire range of it. Alejandro, sorry. I'm looking at a few other things here. It has to be the entire range like that. Right? Because at one point, this looked all green, right? At one point, this looked all green. At one point, this maybe looked all red. So I have to incorporate the entire range, okay? See what that looked like. Was that? Yeah, and you see that was much larger than this one. Not much, a little bit larger than this green candle here. Okay. You know, I am getting a couple of Skypes here, and I have, not that I'm a specific oil trader, I'm not, but I know some of my guys trade oil and they use the Atlas line. I'm just looking at it here. I just want to show you what's developing here in oil. To the long side, it was a short in the morning, based off of the Atlas line. And remember, the Atlas line doesn't have any parameters to, I'll show you here, it doesn't have any parameters to optimize. It's a great thing. You don't have to optimize something and say today it's a value of 4, tomorrow it's a value of 10, next day it's a value of 50. There's no optimization at all. It just configures to what price is doing on its independent market. And so what you have here is a short in crude, and you have a long happening here in crude. And I'm just getting Skypes here. Some traders just took profit. Okay. And the same thing, let's take a look here, what we're doing here. Definitely to the long side here, Atlas line. Yep, so nothing's changing, right? My whole bias right now is long the market. As it's continuing up, I'm looking for pullback or strength trades, all of those good things that a trend gives us in order to continue buying and buying the market. All right. There's no difference here on the Russell. Looks exactly the same. Right. Those of you who trade the Russell, I'm not a big Russell fan, but here's the Russell as well. Right. All right. Any questions, guys? A doji doesn't count, Alejandro. A doji, great question. here, doji, for a news event doesn't count because I don't know if it's going long or short, right? The reality is I don't know what's going to happen. I don't know if the market's going to continue higher or continue lower, so I do nothing with the doji candle. All right, Alejandro, good question. Malcolm, I don't have anything coded for MetaTrader. I use NinjaTrader, TradeStation, as well as eSignal, but I do not have anything on the MetaTrader platform. Not yet. Okay. Stop and profit are ratios, winning losing ratios. How this works, and you have to look at it as a combination of stops. So one of the things that I like to teach is not to just have one stop. Having just one stop in the market ultimately is a failure. We need to be versatile as traders to take an exit or take a stop based on whatever condition is being met. All right. What that means is that if I enter into a trade, I want to have some type of stop that is a proof, or a prove it stop, as I call it. I want to have a type of stop that is a time-based stop, where I'm giving this a certain number of candles, a certain number of bars to allow me to take a profit target. And I also want to have a type of catastrophic stop, which tells me if there is something that completely reverses the market or goes against me very strong, very heavily, I have to protect myself. So the three stops that I use are a catastrophic, just do this here, catastrophic stop, time-based stop, and a prove it stop. Okay. So whichever gets hit first, and there's actually a fourth one called a pivotal stop as well. Okay, pivotal stop. So I look at this and I have to be dynamic. If we have a candle that closes below the Atlas line, right, like this, that is a prove it stop. If we have the market do nothing for 25, 20 minutes, half an hour, 3 hours, 4 hours, am I still going to want to be in this trade? And the answer is no. There's no reason to be in a trade that just ranges forever. I'm going to get out of that and look for something. So I have a time-based stop, typically 4 or 5 candles, depending on the time frame that you trade, 4 or 5 bars. A catastrophic stop is a little bit different because it has to be large enough to keep me in the trade, but I do base it off the ATR. So typically, I'm looking at double the ATR for a catastrophic stop. And that will keep me in line with what's currently happening. Not always. I don't always double it. When the market's more volatile, I can't have a large stop like that. But under these slower conditions, it's double the ATR. And when I look at profit target, I look at using the ATR. You see this average true range here? I use a value of 4 or 5, and I say to myself, what are the current conditions? So if this happens to be at 1.6 on the E-mini, I know that a 1.5 or 5 ticks is what I'm after. If I look at this as being 3 points or 4 points, it's all based on the current conditions. And if you haven't seen a video yet on the ATR, you can go ahead and download the free videos that are available on DayTradeToWin.com, and I think it'll explain to you in a pretty good detail on how I use the ATR and why, more importantly, why. You know, traders usually make similar mistakes. First, they typically go up and down or follow the crowd. As you can see with the news event trade that I take, I'm not following what the crowd is doing. I'm actually looking to do something opposite of the crowd. Another mistake a lot of traders make is they have the same stop regardless if the market is slow or if the market is fast. It's very common. I talk to a lot of traders on a daily basis, and everybody wants a 1-point stop or a 2-point stop. Okay, great. If the conditions of the market dictate that you can use a 2-point stop based on it being about a 2-point range, okay. But if the market's more volatile, 2.5, 3 points, 4 points, let me show you something as an example. I'll give you a perfect example here. Take a look at the current condition here. This candle here gives me a profit target, or a value, I should say, of 1.5 points. If you have a stop of 1 point, it's very likely that this will move up 1.5 points or move down 1.5 points, solely based on the current conditions as you see them, based off the range of the last 4 bars. That's how it's calculated, right? So it takes the last 4 bars and it calculates how, or the average range of the last 4 bars. Okay, so if you have a stop that's smaller than this value, just the current conditions of it moving up and down and up and down will easily stop you out with a tight stop. So if you have a stop that's smaller than the ATR, the likelihood of you getting stopped out just on this normal random up and down notion is going to happen. So you must understand that having a tight stop or smaller stop is not a helpful situation if it's smaller than ATR. Okay? That's the first thing. That's the mistake that a lot of traders make. They have a stop that's not considered in line with the current conditions. The other mistake a lot of traders make is they love to move their limits and their profits, and they don't keep them there. And so let me bring up my dome here. Let me show you something, just as a frame of thought. Okay. Let me see here. Where's my dome here? Okay. So here's my dome here. Okay. And so what you have is you have, let's say that you want to put a limit order here. Okay. And 2 minutes later, you move it like this. And then you move it like that. Oh, hold on a second. Let me just change this here. Okay. You move it like that. I don't want to be filled, guys. Hold on a second. Okay. So let's say that you move it here, and you move it like that, and then you move it again, and then you move it again. Remember the first come, first serve rule, right? And let's say that you're even filled here on a profit target. Okay. You say, no, I want this. No, I'll put it back. No, I'll do this again. No, I think now something else. I'm going to put it over here. And I'm going back to here. I mean, do you realize that every time that you place a trade, or you move it, I should say, every time you move that limit order, you're getting placed in the back of the line. And so I definitely recommend that once you put a profit target in, you keep it there unless this value here changes. And as you're waiting for this specific 3 tick or 6 tick or whatever the case may be, unless you're definitely willing to move it for a reason, put it to break even, or move it to 1 tick in front of it so you can get out, or if this changes from 1.5 points to 1.25 points, now you can say, let's say that this was the original profit target here, like this, say like that, and this value here on the next candle is now tightening up. The market's now starting to range. This value is going to show you that. You would put it and you would adjust it, but you'd keep it there based on what's happening in the current conditions, and so on and so on and so on. So once you place a profit, keep it there. The likelihood of you getting filled if it just touches it increase, because everybody else is moving these targets, and you just get bumped in front of the line. And once 20 minutes or 25 minutes have passed, and you say, all right, I've given this more than enough time to reach my profit, now I can bring it to break even and get out of the trade. Okay. Sierra charts, Joey. I do not have anything with Sierra charts. I have NinjaTrader, TradeStation, and eSignal. Okay. Okay. Andre, for Forex, it's the same thing, but Forex 1.5 isn't the equivalent because it works off of ticks. So you have to look at, here, let me bring up a Euro chart here. Hold on a second. On Forex or on the Euro, it's not based off of points, it's based off of ticks. So this value here, what I want you to do, if you're trying to say it's not in points, it's in ticks, what I want you to do is I want you to move the decimal place over 4 places to the right. And that will tell you not in points but in ticks. So if you look at this currently right here, this says 00121. Okay, it will be the same on Forex or any currency. 0.00121. Right, 0.00121. Okay, 4 places to the right. 1, 2, 3, 4. That is the equivalent of 12 ticks. 3 points on the E-mini or 12 ticks. Okay. 00121, 12 ticks. Okay. Andre, I'm sorry, I'm calling Alejandro. I think it's Andre. Andre. Okay, Christina. Hope you're doing well, Christina, in Austria. I think it's Austria. What are your thoughts in over increasing high frequency trading with robots and algorithms? How to deal with that? You can't. It's part of now everything that happens in the trading world, that you have systems in high frequency trading that just goes for a tick or 2 ticks. You have to go for more than just a tick or 2 because of commissions. I would look to stay out of the market when it's too slow. Anything under 1 here or 4 ticks, anything under 4 ticks. And I would look to stay out of the market anything over 20 ticks, which is very chaotic. That's the best way to deal with not getting caught up when the high frequency trades really push the market very strong and very chaotic. You stay out of it. Or when the market's dead and all they're doing is flip-flopping back and forth, anything under 4 ticks, you stay out of it. We have to have a good movement up or down in order for these high frequency trading algorithms to not affect tight support and resistance or whipsaw channeling. And that's how they affect it. When there's nobody there to trade it, it hits a value, bounces off of it. Okay. I do. And remember, the some of the programs, Finley, are only now available through the mentorship program, like the price action scalping, the ATO. And so if you're interested in getting all of the methods that I teach based off of price, the best way to do it is definitely to take the 8-week program. You get everything, including the Atlas line. There's not, Christina. There's really not. Every algorithm is different. Every algorithm, as far as every algorithm is different, right? And usually they don't go for big. They just go for a tick, maybe 2 ticks. Okay, that's all they go for. Okay. You're welcome, Christina. All right. So what do we have here happening? We have potentially an Atlas line long trade based off of a pullback. So as soon as this candle closes here at 13, if it happens to close here at this price, it'll be a long trade to the upside. It'll be a long trade to the upside. Okay. So I have to wait until this candle closes green in order for there to be another trade to go long, based on what I teach on the outline trades. Anyone have any questions? Anyone have any questions? It depends. Paul wants to know about the winners to losers ratio. It depends on the method. It depends on which on the Atlas line, Paul, or on what I teach in the mentorship program. Because it's a combination. The mentorship program teaches everything, and you take a trade based on whatever's there and whatever you see there. I think that between 75 and 80% is common when you take all the methods into account. If you're looking at just one method, the Atlas line today is doing fantastic. The last day or two, we had some whipsaw, but overall, I would expect about 75 to 80% on the methods that I teach if you follow the rules properly. Okay. You can call me, absolutely. Here's the phone number, right? If anyone wants to contact me and find out more about the program that's coming up next week, starts on the 15th, 888-607-0008. Feel free to call. You can talk to me. You can talk to Nate, is my support person. He's the one that helps install any software, any courses on your computer, and he'll answer all your questions, making sure that this is a right fit for you as well. Okay. Absolutely, Paul. The method or setup that gives a major move is the roadmap. The roadmap setup that I teach is the one that is a huge reversal that occurs. Yes. So the answer is yes, Paul, to that. All right, one last thing that I want to talk about. And Bob, yes, I am. I think Bob had a question here. Bob Cunha from New Jersey. I lost your question here, Bob. But yes, I am going to post this recording on the blog if you missed it. Yes, there it is. I will absolutely post this for you guys to review and to learn from it. Bob from Jersey, absolutely. One last thing is I don't like to do predictions. Okay, so if I say to you, tomorrow the market's going to go up, don't believe me, because I very rarely want to make a prediction like that. Okay, I want to instead wait for price to get there and then take some type of setup based on it going long or going short. Okay. That being said, I did make a prediction in January, and I said it in the beginning of January, and I said it at the end of January. It's called the January effect. And this is something that every insider in the analytical trading house knows about. And not a lot of traders, retail guys, know about this. So I try to pass along as much inside information as I can, telling you guys what to expect. Sometimes it's a longer term move, but definitely this is very, very important. January started and ended, and it was a higher close than open. Okay, higher close than open. And a higher close than open for the first month of any year almost always dictates, and I can't say 100% of the time, but it almost always dictates that the year will be much higher, close much higher. And so we have all this news coming out that says the economy's terrible and everybody's unemployed and the real estate, commercial real estate market is tanking. And you hear all these outside sources, but you fail to realize what has just occurred based on price showing you
this January effect that has been very, very high probability for many, many years. And there's another one too that we use. And so I said, look, this happened. We had a higher close. It's time to buy the market, buy the market, buy the market, buy the market, buy the market. I said it numerous times, and some of you guys listened to me because I did get your emails. So you're very welcome. And some of you stayed on the sidelines, which is fine, right? Let's see what happens with what he's saying. Market rallied 100 points from the end of January to March, I think it was. I'll bring up the chart here in a second. And then it pulled back. And then I said again, when it pulled back below January's high, it's time to buy because the market is going to, let me see if I can bring up this chart here. Because it's time to buy because we went, actually it's right here. Okay, this is the chart that I used yesterday in the blog post. Okay, so here we have January open, close. It was a higher close and open. I said buy. It rallied 100 points. And then let me just take a look here. And then I don't know if you can see that, but oh, there it is. In May, June, right? In May, June, you see that price fell below January's close. And again, I recommended to buy the market because the year will close higher. And this is exactly where we are once again. Right? This is exactly where we are once again. Another 100-point move. Now, I don't want to say that this is always the case, but I will tell you that the way the prediction goes, this effect, is that we are going to have a higher close at the end of the year compared to January's closing price. Now, another opportunity to get in on this would be if price falls below January's high. If price falls below January's high, just like it did here in May or June, right? I'm sorry, May, June here. Buy it. Okay, buy it. Okay, so just a little bit of theory for you guys who are hungry for theory, and that's how it works. All right, guys, I got to run. I actually have a meeting that I have to go to, but if you have any questions, feel free to email me. If you want to call me or you want to learn more about the mentorship program, it's on special, so why not take advantage of these savings now? Spend 8 weeks with me. I'll show you so much more information than just what I showed you here. There's a discount now. I want to fill the last, I think I have 2 or 3 seats available, so I want to fill them up and spend the next 8 weeks with me. All right, guys. Hopefully you guys learned something. And I'll talk to you soon. Maybe I'll have another webinar next week if I can. You got it, guys. Thank you, Bob. At 1 o'clock, Rob. We're going to meet at 1. Yep. Absolutely.